If markets are going up and your investments are looking strong, should you rebalance your portfolio? In this video, I'm going to dive into why you can and should rebalance your portfolio and some of the main ways in which you can do it as an everyday investor who's looking for a relatively simple and easy way to do it. Because I do find that this is a common point that a lot of people hit, and there's not actually that many solutions out there that explain exactly how you can manage your portfolio going into the future. Because there's loads of stuff out there about all the hype of getting started investing, how to get going, picking whatever it is that you're going to invest into, and then it's kind of like you reach a cliff edge where you're like, oh God, now what? Because I'm looking at them and I don't know when to sell. Should I sell? How do I sell? And also, how do I make sure that I'm actually doing this right? Because that is a key worry that I know a lot of people have when they're investors. So if you've had any of those thoughts, you're in the right place. Stick around. Hi, I'm Zoe and I'm a former wealth manager. This is my channel, Words on Wealth, where I break down key investing concepts and headlines to make you a confident investor. Back to then the rebalancing. I'm finding it's becoming a topic that's growing ever more important as we are seeing markets hit once again all-time highs. And while some investors are super excited about this, others are also cautious as to what it could mean for their portfolios, particularly if they're at a stage where they are nearer to their goal and are starting to think about the potential withdrawals and the risks that that could open them up to if their portfolio were to take a downturn at the worst possible moment. But before we do dive into that, I think it's really crucial that we talk a little bit about some of the theory of risk that actually underpins a lot of why we do rebalance. Generally, when we're picking investments, we take into account our time horizon and also our risk profile, which if you are an investor, I'm sure you may have done in some way, shape or form. Normally, as a rule of thumb, the longer the time horizon we've got, the more risk we can afford to take. And the reason for that is because there is time to ride out the potential ups and downs within the market. Now, usually what this translates to in real life is a combination of stocks and bonds in the most traditional sense. And usually, if you're further away from your goal, you'd have more stocks at a higher risk level. So there'd be more things like small caps, maybe emerging markets in there as well. You'd have greater exposure to higher growth, higher risk potential investments and lower exposure to things like bonds. Now, as you move through, for example, your life, if we're talking about a retirement portfolio here, normally as you near retirement age, you increase your exposure to bonds and you decrease your exposure to stocks and particularly higher risk stocks as well. So the reason why rebalancing is really key is to try and manage that risk, because this theory is all beautiful in the way that it pans out. You're evening through, moving to lower risk ideas and keeping them all in line with your age. But if you don't then keep on top of that, what you're potentially doing is opening yourself up to a situation where your portfolio is exposed to greater levels of risk than you initially intended because, for example, you've suddenly got a huge percentage of stocks in there rather than, for example, bonds. So there's three main ways of approaching portfolio rebalancing. They are the contributions method, the time method, and the threshold method. I'm going to start with the contribution-based method, which is the one that people most commonly apply when they're moving through what we call the accumulation phase, aka you're in the part where you're very much focusing on growing your investing portfolio and you're not super close to withdrawing or indeed already taking money from it. Method is also useful is for those who are investing outside of tax efficient accounts such as the ISA in the UK, the Roth or the 401k in the US, or indeed any others across the globe, because often if you start selling parts of your portfolio, you may well pay taxes on it. The contribution method helps to avoid that. So the way that the contribution methods work is relatively simple. All it does is, as you are contributing to your investing portfolio, you rebalance in the amounts that you're putting into different assets. So the whole idea of rebalancing in this sense is getting your portfolio back to where you initially set it out to be. So if you're still at a stage of life where you're wanting it to be, let's say 80% stocks and 20% bonds, and for whatever reason your stocks have taken off and they're now worth 90% of your portfolio and your bonds are only worth 10%, what you do with the contribution method is you would simply put more into those bonds, less into those stocks, and via those contribution deficits, you help to even out what is going in to each and every asset class. This, over time, should help to rebalance. But it's definitely a more manual way of doing it. Now, the second main method is what we call the calendar method. This is where you check in on your portfolio, perhaps quarterly, biannually, or annually. And at this point, you have a look at the splits, where they're at, and sell accordingly. So let's go again to that 80-20 split. Let's say you're 80% stocks, 20% bonds, and suddenly those 80% have grown to 90%. Rather than redirecting contributions elsewhere, as you would have done in the first method, what you would do is you'd sell 10% of your stocks, move them into the bonds. Now you might be thinking, but then surely I'm selling what is doing best. That just doesn't make sense. And you wouldn't be wrong. But what you're actually doing is helping to maintain the risk. If you do backdate and use, for example, portfolio visualizer tools, you will often find that selling does mean that you get slightly lower gains over the long run. And there's no two ways about that, there's no avoiding it. But that's not what investing is all about, because if we knew what the magic number was to get the highest possible gains possible, then of course we'd all be billion trillionaires and we'd all be using these specific formulas. But actually, what this calendar method does is it helps to keep and maintain the risk levels in your portfolio. Because if you want an 80-20 split, there's a reason why you want it. You don't want to get to a point where your portfolio is 95% stocks and only 5% bonds, because that could open you up to a real downturn in your portfolio if, for example, the stock market does come down. Now, the key disadvantage with this method is all about taxes. I mentioned it in the contribution method as an advantage of that one, and it is a real disadvantage of this one. So if you're investing through tax-efficient accounts, again like the ISA or pensions in other countries, then that isn't even a factor to consider. But if you are using brokerage accounts, you might want to double check that this does line up with whatever your tax system is that you've got going with your investments, and you're not going to penalise yourself unnecessarily via this rebalancing method. Now, last but not least is the threshold method. And this is where you set a certain threshold at which you decide to then rebalance. So rather than the calendar one, which is arguably a little bit more hands-off of the three methods that there are, because you're only doing it perhaps once a quarter, half every 6 months or every year. So what you're doing with the threshold method is you are setting a certain threshold at which you're going to automatically drop in and make those changes. So let's come back to the same example that I've been using. Let's say you wanted an 80-20 split, it's gone up to 90%, and that's now hit a 10% threshold. At this point, it might be that that is your threshold, and so you decide to sell and bring back down. Now, if let's say it goes to 87% and you've still got therefore 13% bonds, you might just leave it as it is, allowing the growth to be enjoyed for a little bit longer and also reducing, for example, the overall trades that there might well be if you are checking in relatively regularly, let's say quarterly, and selling it to bring it back. Now, of course, on this threshold method, there is two main issues that arise. The first is, well, what thresholds should I actually set? The way that you find the threshold that you're comfortable with, for me, is by the combination of having a look at the likes of the portfolio visualizer tool to work out how much the different asset classes in your portfolio have moved, because if you've picked particularly volatile asset classes, then choosing a threshold that is really low isn't going to work because you're going to be constantly changing it. So you do need to have a look at the past performance to make sure it aligns with whatever assets it is that you've got in your portfolio before making a threshold decision. And then the second part is, what are you kind of happy and comfortable with? Use, again, tools, if you can, that help to see how much things are going to move. If you're not comfortable with seeing a potential downturn of your portfolio that exceeds X amount, whatever that might be, you'll know in your gut, then set that as your threshold. As a rule of thumb, most people do normally pick around the 5 to 10% mark. It's a good starting point that helps to allow for a little bit of growth and a little bit of wriggle room and natural changes in the portfolio without becoming too excessive either way. So there you have some of the main methods of rebalancing your portfolio. Hopefully that has been super helpful. Do make sure that you like, subscribe, and turn on your notifications if you are enjoying these videos. And if you're unsure of where to start, I have got an ebook which I'll link in the comments, which can really help you get going with picking your overall portfolio composition and getting started with a simple blend of different ETFs. As always, I'm all ears, so do let me know in comments if you've got any questions about this rebalancing, how it would look for you, and also how you manage it into the future. Thanks for watching, and bye for now.